Good afternoon. Good afternoon, ladies and gentlemen. It's Jesse Colombo, Cyber Trading University's Forex and Futures instructor. Oops. Good afternoon, ladies and gentlemen. Sorry about that. My computer's freezing up a little bit. So, today we have Saul Shaoul from PitIntelligence on our closing bell, and he's going to be teaching us how to trade for a living using trading levels and strategies. He's going to be explaining how to use the price action scalping strategies as a floor trader, as well as how to scalp the market utilizing his trading floor levels, including pivots, key support resistance levels, and more. And he'll also explain how to scalp with intraday fades and momentum trades. So thank you so much, Saul, for coming on. I'm really looking forward to it.
All right. Just want to make sure that everybody can hear me okay.
Yes.
If somebody. All right, great. All right, thank you very much, Dear Jesse. Appreciate the opportunity here to talk to some of the people from Cyber Trading University, and just want to first make the distinction that we're trading futures here versus any type of stocks, but there's a lot of similarities, as you will find out. I think last week we had a nice webinar with um, Bosco, and he was very informative as to what some of the things that he looks at, and we kind of look at a lot of the same things that they look at, and I just want to share them with you and see if there's anybody here interested in trading getting an opportunity to trade futures, as I think it's very exciting and probably one of the last areas where we can actually, trade for ourselves and make decent living. And even though it's tough, there's no doubt about it. Just like any trading out there is tough. So let's just before I even start here, I just want to make sure that everybody knows that you are welcome to come into our trading room. And our room is I'm from the I do my room here from the floor of the CME or the Chicago Board of Trade, whichever. And yes, they closed some of the trading outcry open outcry pits, but most of them are still open in regards to the options, which keeps the floor live and action packed. So we still get the ability to have a lot of action on the floor, especially the S&P pit, which is still open and gives us a little bit of an opportunity here to stay awake and to be able to trade with some of the ebbs and flows of the market that the market usually has. If you hear some of the construction that's going on, they're doing some work. They're realigning some pits, and so you hear a lot of banging in the background, and then you hear some bells going off every now and then. It's simply because of the work, or some of the people that are working on the floor, even though the floor did officially close here just at 3:15 Chicago time, which is the last time that you can trade the futures until they start trading on the Globex in about well, they start at 3:30 right around now, and they go till about 4:30, and then close for a little bit. Anyway, but let me just give you a little overview of what we're trying to cover here on the in our webinar. Again, we're going to be trading futures. We're going to be looking at entry points and exit strategies that we talk about with our traders. Just like stocks are, you have support and resistance levels that the stock gives you. We're looking at support and resistance that each individual market gives us. We're looking at S&Ps, many S&Ps, and we look at bonds also to give us some kind of correlation as to which way S&Ps might be going. A little backup, so to speak. And sometimes there's a direct correlation between the two, and sometimes there's an inverse relationship between the two. It depends on what's going on, especially with everything so interest rate sensitive, especially with the Fed and all their talk about raising rates or not. So we have that to look at, and we think, or I feel, that bonds kind of tell you the story, and especially since I traded in the bond pit for many year before we made this transition back onto the screen here. So I think bonds are always telling us some kind of story. There's no doubt about it. Please feel free to ask questions as going along here. I like it much better than to just keep hold the questions till the end. It's much easier for me to understand that you guys are understanding what I'm talking about, or instead of me just talking, and hopefully I can explain something to one or two of you, and that it will help us all be on the same page. So we talk about pivot points. There's a floor pivot that we look at. It kind of is very interesting. We feel that the pivot that we get off the floor is an important one, and it's one that keeps us on the right side of the market. You have to remember that we are trading in and out of the markets. We're looking for ebbs and flows in the market. When there's some volatility, which is something that every trader likes to some extent, not crazy volatility, but some decent volatility, because we all believe that markets or stocks and futures don't go up one way or straight down the other way. They usually have ebbs and flows of the market, and usually you're looking at support and resistance to give you those bounces off. We do also look at, obviously, some momentum trades that we look at every now and then, but we focus in on price action. I feel that the only real um, unbiased type of indicator that's out there, and time-related indicator too, because a lot of the indicators are very time sensitive and late, but the one very clean indicator that we have is price action, which helps us trying to get some idea of where the market's going, the volume that's all of a sudden coming in at a certain price. And those are important levels. I think we talked about it last week with certain areas that there's a high volume concentration at a certain price that there's something that has to be looked at, and the same thing in futures too, with any type of level that the market gets to. So there's levels, the support and resistance levels, there's price levels that we look at, and all of these things we clump into some kind of methodology to help us trade. And we do this every day is different. Obviously there's not, we don't trade many stocks like some other stocks do, but we just look at one commodity, and in that commodity there's many opportunities. And so that's what we try to look at more than anything else, is to look at the opportunities that each the stocks, our commodity gives us during the course of the day. So we'll also look at, you'll see our template that we give out. We'll also look at a little bit of money management and a little bit of psychology that we talk about, because trader psychology is very important to most of us. I think we need to have a clear understanding of what we're trying to do, and how we're trying to achieve those goals. And sometimes our personalities and or our frustrations, or you let the better, you don't stay focused because you're worried about money, and those situations come into play. So what we try to do in the methodology that we teach is that we try to take that aspect of worrying about the money aspect out of it by keeping tight stops, and also by understanding, having many reasons why we're entering a trade. All right, so just this first chart here is a little quick uh, chart as to this is a bond chart, and let me just get this going here. All right, and basically what we're trying to do is we're trying to find patterns, technical patterns that the markets are going to trade off of. And here, the first line that we have here is basically the pivot that we had for the day. And we opened up and we're trading above it, but once we started trading below it, it kind of opened up the door to trade lower. But at the same time, we needed a good technical reason for us to get short. So the market, because of the way the price action dictated, there was some price action at these certain levels underneath that created us, or allowed us, I should say, to get short, to be able to take advantage of these little moves here going down. So, again, we're looking at what the price action is telling us, and once the price action dictates something, it opens up the door for different trades. And so in this situation, even though we were above our pivot, once the price action set it up for us, we had a reason to get short. And remember, we need reasons to enter our trades. That's supposed to be an R. I'm not going to write with this thing. It's too hard. You're going to need reasons. We try to layer in the reasons why we're getting into trades more than anything else. And obviously, we show you what the reasons are, and make you more comfortable as you enter the trade. Because you got to remember, I'm trying to take your emotion out of the trade. And that's the one thing that we try to do by explaining things, telling you why we're going to enter a trade, and then to recognize that situation, and once you recognize that situation, you'll be able to execute the trade. So remember, there's two parts to commodity trading that's very tough: is recognition of the trade, which is what we focus in our teaching, and also the execution, which is the one thing that each individual has to take it upon himself to try to figure out. And that's very tough, sometimes very hard to do. So that's where we get the difference between traders who are making money, traders who are not. And just to give you an example, I could teach 100 traders kind of the same methodology. We'll have 33 traders that will make money, 33 traders that'll not make money and kind of break even, and then 33 traders that'll lose a little bit. So, it's all a matter of how you perceive what I say, how do you see the lessons, and how do you see the methodology, and then the execution part of it is the real tough part. So we have a question here. Bonds normally go lower when stocks go higher. So we got a little inverse trade there. When they raise rates in September, I guess that's a statement, should they both go down? Um, well, but let's first look at the bond market and see what it's done here over the last uh, you know month or so. The bond market has rallied over the last month, a quarter point to 35 basis points. Okay, so there is an answer about when they raise rates in September. I don't think the bond market would be rallying in the face of any type of rate increase, but would you expect the market, both bonds and equities, to go lower? It's a very tough question right now because of how much footing, or not footing, but how deep the Fed is um, into the market with what they have to do to get themselves out of this little pickle that they got into with all the quantitative easing and everything. So they have a lot of work to do. Would you expect rates to go up and bonds to go down? Yes, you would expect that to happen. But over the last uh, week or so, especially last week after China had its little bit of an issue, I think the Fed is going to be hard pressed to raise rates because we are into this global economy, quote unquote, that the market has all of a sudden, uh, you know, looking at. So that global economy is keeping our, raising rates in tow, I think. So I think there's a lot more pressure than just what's happening here. And if you look at what's happening here, it's another story altogether. So, all right, so we have levels that we teach, and we have try to give you reasons while you get into your trades. And once we get into a position, then we're looking for a little push here to the downside, as this move did create. Once we had a reason to sell, here, created this little push. We had our first floor support on this line over here, and as you can see, the market did trace down to it. And in this situation, we have two opportunities to trade. You can either buy this level because there's an important level, otherwise we wouldn't be having it as support and resistance. And we did get a little bit of a bounce off of that level. And consequently, we were able to take, if you didn't take advantage of being short up here, down to here, then you could have taken advantage of buying the support level with a stop, obviously, and making a little bit of a profit potential on the up rotation back up. Again, we're trying to take advantage of ebbs and flows of the market. So consequently, that's one: ebbs and flow of the market. We don't expect the market to go straight down. If we were short, obviously you're buying it down here against that level of support and covering your position. But if you didn't and you were just got in, watch what's going on, there's a little buying opportunity for us. So again, these are ebbs and flows of the market. That's what we're trying to do here. And it's just like stocks, where you do have support and resistance levels, and most of your brokers are going to be telling you to buy some support here, a 200 moving day or 50-day average or something like that, and you're buying it based on technical reasons. And we're looking at technical reasons, but we're looking at technical reasons on an everyday basis, not just a one-day basis, because we get volatility almost every day. Well, except for today, but we've had some volatility. And so consequently, the volatility, well, let's say this volatility here, creates support and resistance on the way back up, right? You have these levels will become, that were all old support, now become resistance the same way. And so they could retrace, as they have been lately a lot, and it gives us an opportunity on the way back up to make a little bit of money also. So I guess you have to question, why do support and resistance work that way? Why does a support level on one time acts as resistance the next time around? And the easy answer, I think, would be simply because when you get to a certain support level, there's some buyers that are coming into the market, especially a support level that a lot of traders are looking at. And so the bigger traders, they're not like, if they buy it down there and the market goes through it, they're probably going to buy the next support level down below at the bigger traders, because they're not going to be scared out by 3 or 4 points on the S&Ps. So what happens is when the rotation back bounces rotation back up to the original support level, they'll probably get out of that original uh, price that they got themselves into, and that creates a little bit of hesitation on the market from going up. So that's why there's ebbs and flows in the market, and that's why we're able to take advantage of that. And that's what we're looking at. But that's why some old support becomes resistance, and the old adage like that. Is it easier to short minis and versus stocks? Well, actually, if most commodity traders do like to short markets, because they like markets when they go down. They seem to go down a lot quicker than going up. But if you've been trading at all, if you've been trading S&Ps, I'm sorry, if you've been trading futures at all, you'll notice that it's very easy to enter into any short or long position. And I don't quite know if it's that easy or not with stocks, because if I had to short a stock, I'd put an order and my money would be there and everything like this is taken care of. But here it's a little bit different. You have your account. Your account allows you to, enter into a position, and your position is tallied up at the end of the day. We don't like to take any positions overnight. It's not one of our strong suits, and it's something that we try to stay away from. Simply because there's just too much, especially these days, too much, um, global fluctuations. Anything could happen. If there was a bombing anywhere, you're going to have S&Ps open up 20 points lower, and 20 points on a each point on a one lot is $50. So you're looking at $1,000 hit before the even market opens. And it's really not. There's going to be plenty of opportunity for us to trade if something like that happens. So you don't need to start the day on a negative with a negative mindset, which is very important, because you need to keep that positive mindset as we're trading. Very important to have that, even because when we start getting down during the day, if we get down, you need to be able to feel like you can come back. You don't want to start the day down. That's gets you, you know, into a deeper situation, and you're always fighting to climb back up. So don't like to have positions, only because of the global situations that are happening these days. So in this situation, this little chart that we have up here, we have just shows you how trend line and support levels work. But how we do it is, this is the course of a day, and so we had the original trend line up here, right? And once it came through it over here and kind of bounced back up above it, I redrew it and made a lower trend line, which helped us pick up this support level uh, over here as the market came back down to it the third time. So because we're trading futures, because the markets move, ebbs and flows, you're given opportunities to adjust, and you have to adjust, and you have to know when to adjust either your technical trend lines, or some of your our support and resistance levels as they go along. We look at Bollinger Bands only because I think they work pretty nicely. And we have a moving average that we've come up with here at Floor Traders Club that allows us to use that as support and resistance as well. And I'll show you in the real live charts today how that kind of worked out for us as well. Even though today was not many good opportunities, but that's fine too. The one thing that we try to remember not to do is not to create a lot of commissions for brokers. We try to keep everything to about 4 or 5 different trades in the course of a day, and some of you might think that's a lot, but for futures trading, that's really not that much. And you're looking to uh, buy in at good support, and or maybe have an opportunity to sell some momentum depending on how the market sets itself up, and consequently you'll be able to, uh, with 4 or 5 trades in the course of a day, that keeps your commissions pretty low and the ability to make money high. And even if you lose money, you're not paying a lot of money to Mr. IB or whoever your broker might be. So again, so in this little chart here, again, a little different, but the market does set up very nicely for a little opportunity to sell. Again, reasons, we need reasons. We talk about reasons all day long in our room. We talk about reasons in our class, in our methodology, where we're showing you reasons. We're telling you why markets do what they do sometimes, and then I try to use some of my experience to trying to help you with understanding sometimes what's going on there. Sometimes I don't get it, and when I don't get it, I usually stop trading because it's just not. I've been here long enough to know that if something starts acting goofy enough, it's not that I'm not understanding. Usually means that I should be, something's going on in the background, like maybe some plane falling out, some bomb being blown up, some Navy ship being sent someplace, some all kinds of goofy things that are happening. It could happen at any moment while you're trading. Just like it couldn't, when you're trading stocks too, anything could happen at any moment in time. So but again, we were looking for reasons. There was a nice little reason to sell technically with that double bottom right there. And that allows us to come down here to our first level of support, which if you did buy it, bounce back up here a little bit to give us a little ebbs and flow type of situation. Now, as you can see here, I do this line here. There is like that first support now becomes resistance. So as you can see on this rotation back up, market did have a little bit of a tough time getting through there. So what I would have said was that if we get above a certain price range, just above it, that I'd want to be out of any shorts in the market, simply because it seems like we're going to start to bust through, and we don't want to be short because we're short, if we get above this little bridge that the market is creating, a little shelf or ceiling, depending on how you want to look at it, we have a chance to go right back up here to this area up here because there's a lot of empty space in this little move here. So we don't want to let the thing run up on us. We just want to take a good opportunity to make a little bit of money. And if we can have a nice little tight stop, there's no reason why we can't put the trade on. We're usually looking for about 2 points on our stops. So that's about $100 per one contract. And we're also looking for a 2 point uh, target minimum. Sometimes we can get a little bit more. Sometimes the market's not giving us that, so we'll take a little bit less. Again, it all depends on the type of volatility we get that day, and so on and so forth. So again, it's one of those things where that's a kind of our goal. So we're looking at 5 trades a day potentially for right $500 on each one lot, and if you can do that consistently over the course of a week, 2 weeks, it starts adding up very easily. And then you obviously are trying to get more than one lot on, and you can just go to numbers whichever way you want to go. All right, so you can see here again, a little down push here to our target, had a little bit of rotation. These levels seem to be working very nicely, and they kind of stop. And again, these levels also act as resistance on the way back up. So these levels, once they get penetrated, opens up the trade to higher trade, which allows us to have some kind of momentum trade on the way back up here also later on or whenever we get back up there. So what I like to do is I have a little booklet that I write all my levels on, and then I kind of remember them. I write down which ones work really well, which market kind of shelved out here, and then that reminds me for the next time when we get to that point that we might have a little bit of a little push to the upside based on some increased buying because there's some resistance that kind of the market kind of broke through. So again, every day is different. That's one thing that we like about this business because there's different opportunities, different days, and we kind of kind of keep that in focus and gives us an opportunity to have different opportunities every day to make money. It's very important. We don't look at the same thing every day. Every day you have to come into it with a fresh mind, a fresh look at things. We try to look at the geopolitical situations that are happening around the world to try to give us a little bit of help. And but sometimes though, I like to come in with no opinion. If you have an opinion when the market opens up, usually tends to not go your way. I feel that opinions kind of hurt. We like to just look at the price action. We like to look at the what the market is telling us, previous levels of support and resistance, and through all of that, give you builds up an opportunity to say, all right, well, this is what I'm looking to buy, this is what I'm looking to sell, and then I'm going to trade the market because those levels are hit, not so much because I think the market's going up and I was going to start to buy it. Do price action dominate how E-minis move? It's a good question. I think at times it does. I think when there is an onslaught of buying at one time, I think it would be reflected in the price action and then would dominate. And I'll give you an example. For yesterday's trade was like that. Yesterday afternoon's trade. Well, why don't I kind of try to show you since I have the. Let me see here. Give me 1 second here while I um, switch screens. All right. Okay, so here's our screen that we had yesterday. Here's our rally that I was talking about. This is our uh, um, S&P chart, and here we bottomed out at this 74. And then what happened was we had one huge rally, almost about 15 points in the S&Ps, which correlates to roughly about 130, 140 points in the Dow, all in like an hour, but seemed like a lot less than that. And this rally, as you can see here, probably, this bar, more dominant than any of these other bars that we ever had, created the follow through the rest of the day to keep us on the long side. So price action dominate how we minis move. I would say probably in this situation, not all the time though. In today's trade, if we go and look at today's trade, where we're basically doing nothing, we're in a tight little range here between 98 and 92. And look at this. This is an hourly bar. This is an hourly bar. So you can see how, compared to this, we got this today. So no, today price action doesn't dominate. Support and resistance dominate. Yesterday, I would have to say, because of this bar and the way it moved, we had a little buy above 90 here someplace. I think that's 90. We had a little buy above 90 once we settled down here a little bit, and that kept us, tried to keep us long in the room. Uh, the rest of the way to get a little bit of money back, because we got a little bit, I have to be honest with you, got a little bit hurt on this rotation back up, because we had this level of resistance here, kind of blew right through it, so I mean, it happens, and why did that happen? That's the thing. Remember I said we try not to come in with any opinion, right? So, well, I heard afterwards that Goldman was buying a whole bunch of S&Ps. Every time I try to write, something bad happens, like you can't read it. It's supposed to be Goldman. Goldman buying. All right. That's an L. There you go. So they were buying here, but of course, they obviously bought a whole bunch, created the market, move, and then everybody got pretty much stuck going on the way back up. So gave us a reason to want to be long. Once we found a reason to be long, remember, I had to find a reason to be long. I just didn't just jump in. But once I found a reason to be long, due to price action, then that allowed me to kind of stay long somewhat the rest of the way, even though it was very, very quiet after that. All right. So yeah, that was yesterday's price action. So since I'm here, let me show you. This is our format that we have in our room with the 4 charts, and with the 4 charts going from right to left. We have a 5-minute ES chart, followed by a 60-minute ES chart, followed by a 5-minute 30-year bond chart, followed by a 5-minute 10-year bond chart. So we kind of keep all the things that are important to what we're trying to trade here on one little chart and on one little screen, and it gives me an opportunity just to focus in on what one market's doing and how the other market's reacting. As you can see, the bond market here had a little bit of a hiccup starting like at 1 o'clock, and decided to continue all the way down. Here at 1 o'clock, we didn't, nothing. Nothing, right? Nothing till the end, while these guys, had a nice little big move. So it's not always that we have inverse trade or inverse relationship between the two markets. Sometimes it just kind of does it on its own because market was going to close at 2 o'clock, and there was obviously some selling that had to come into that market, in the bond market, in the last hour. We obviously had a little bit of a sale here, as you can see, with that nice little shelf that was created by this move. So once we got through right there, you really had a good opportunity to sell it with no risk. Each one of these ticks is $31.25. So this can get expensive fast if we're wrong. But if you got in here, it took no heat. Even if you know cashed it in here, it was like, this is a 12 tick range. 12. This $375 in about 25 minutes on a one lot. If we You could easily found a reason to get short here and have a trailing stop. You could have probably taken a lot of this move with a trailing stop. So do I trade crude, oil, and gold? No and no. My philosophy is that try to stick to markets that uh, I have some idea what's going on. Um, and when my buddy here trades gold, trades oil next to me, and he loves it. I think it's crazy. I think it moves. It moves, but so do S&Ps. I think I have a logical reason why S&Ps move, where I don't have a logical reason why gold moves, besides the fact that it's crazy. So if I come to that conclusion that the market is just crazy, it kind of keeps me away from really getting into trading that market. Gold, again, I don't know what makes that market move, and since I don't know what makes that market move besides what everybody hears on TV and stuff like that, you know, dollar and supply and demand and the economy. Yeah, you could, again, it's one of those markets that a few players know what they're doing, and I'll just stick to the markets that I have some idea what I'm doing. At least everybody understands stocks, right? You understand why they move up, why they move down, and at least you can make some kind of rationale, somewhat. I just don't have any rationale for crude at all. All right, so here, this is the um, uh, our screen, like I talked about, and this is our invitation for you to come into our room, and uh, this is a special offer that we have for anybody that's part of the webinar today. And you can see here that if you have to click onto that link that they're putting up on the screen here, you'll be able to just click onto that link. Give us your proper email, because you get an email that comes back that allows you back into the room, and that email will give you the ability to come back in the room, and you can just come and listen in to see what we're doing. And the link is being put up right now again for us. So again, it's you got just come and listen to what we talk about, how we deal with our markets, how we deal with volatility. You get where our pivots are, and we give those out before the market opens. I give you our levels before the market opens. And in the classes and the methodology that we teach, I show you how to create those levels. The end result of what we're trying to do here is to be able to let you trade your own. We feel it's very important at the end of the day that whatever we teach, you'll be able to put your own price action methodology of trading together. Obviously, stuff that we teach you helps with creating that price action movement and what we're talking about. So this is an opportunity for you to trade futures if you haven't done it before. If you look at come talk to some traders who've done. We have some great traders in our room who listen to me from the floor, and once in a while they do come in here, and they do come and let them talk in the room and give you different ideas, because I think everybody has traders are out there giving you different ideas. It helps everybody. Every now and then you get a spin on the concept that you're looking at, but it's explained differently, and sometimes it's easier for you to comprehend. So yeah, it's come in, listen to what we do for a week, ask questions, feel free. If you like what we do at the end of the day, much better for both of us. I think you'll enjoy what we do, and especially if you're a trader, like, and if you want to be an everyday trader, like most of the guys, girls, and guys in our room do. And it's enjoyable because it's different every day, like I said. All right, so hope you, again, their link is right there. Just click onto that link. Whatever comes up, fill it out. Don't give us a bogus email because that's your way back in. All right. So again, this is this is a nice volatile day here. A number comes out, have a little spike here on the number, then they rotate it back, and then we bounce through, get some nice resistance, right? And once we get through the resistance, a little buy area there, and we continue to push through to the upside. You could have made a case for stopping right in here. You could have made a case for trying to be long with any sell-off below a certain level here, give you an opportunity to catch this move. You could have just waited till we got above this double top, quad top, going all the way over to overnight. Look at this. Very nice little entry point there. Nice little bar here, right? That's crazy little bar there too, right? Anyway, but all these things that we talk about, we kind of show them in the room, kind of give you an ability to look at them from a different perspective, my perspective, but we're also at the same time letting you try to notice them yourself and to be able to recognize the trades yourself, because that's the most important thing, is that we're trying to let you recognize the trades and to be able to execute the trades on your own versus me kind of just being there for you. If you have questions that you want to throw at me, and then we can talk about them, and ask me if you like this trade or that trade, absolutely. Those are good questions that I welcome anybody in our room to do, because those are what keeps, I might not see something that somebody else is seeing, so it keeps everybody on top of things, and we're all helping each other out. And at the end of the day, that's what we're trying to do. We're all trying to make money. There's plenty of money being made here by everyone. Just remember that. We don't have. There's no reason to keep a big secret here as to, if we catch them, if we see something that we recognize a trade that we should all be taking. Plenty of opportunity for everybody to make money. I can tell you that much. All right. Again, just kind of some variations of some of the things that we look at. I'm not going to explain them all. I think they're kind of pretty self-explanatory, I think. Again, some of the things that I've talked about kind of just repetitious. So let's see if we can talk about, um, these are kind of like trader psychology points that I feel that are important for everyone, whether you're trading stocks or you're trading futures, anything. And if you kind of keep these ideas kind of floating in your head, it'll give you an ability to kind of maybe stay out of trouble a little bit, or maybe just come back if you're having a bad day. Okay, and to be patient most of all. So no single trade is important as the process of trading, which I must focus. Again, you have a methodology that's out there. You have methodology that works, and yeah, you have to believe in it. And so, if we get run over on one or two trades, it doesn't mean that the next trade is going to be bad, because we know over the course of time that what we're doing here works. And so you have to believe in that. And if you do, then we'll get through that bad day. Okay. I believe it's not my job to know whether a trade will be a winner or a loser. It's my job to recognize the signal and then act upon it. Again, very important to be able to put that trade aside, the last trade, whether it was a loser or a winner, it doesn't matter. You have to be able to put that trade aside and then go on to the next opportunity, because we're going to sit there and we're traders, so we're looking for next opportunities. That's what we're trying to do. Whether you're trading stocks or you're trading a stock or you're trading multiple stocks, you're looking for different support and resistance levels to get in. You're waiting for those support and resistance levels to get in, and they'll consequently, we're doing the same thing, but on a futures basis, where we're looking at ebbs and flows of the market, and waiting for those levels to get triggered. Yeah, we probably have those levels that get triggered a few more times than most other stocks do, but that's okay. I mean, like I said, if we get 5 trades a day, that's good. Sometimes we get more. Today we got less, so it's all right. Not a big deal. Be patient, wait for the opportunities. That's very important, especially when we went to the screen, at the trading on the screen here, because simply, I'll be honest with you, when I was in the pit trading, I would just, go in and out of the market. I'd have a position, long or short. It was really not that important. I was just trading ebbs and flows of the market. And I'd have a position almost all the time. But now, since I made this transformation to electronic trading, I've had to pick my spots, Had to be very patient. Have to be learn to be very patient. Have to be look for why I'm entering my trades. If I layer my reasons in there, and I like the trade, then I'm gonna just appreciate that trade even more. But I had to learn to do that. It just did not happen. It's very important to learn to wait for those opportunities, and especially if you're trading futures, because when you can see a futures screen, if you watch a ladder ticket, market moves quickly, moves a lot, and you feel sometimes like, oh my God, what am I missing? But you're not missing anything. I mean, you're just not missing anything. Like I showed you today's chart. When you are when you're staying in a little let me see. When you're staying in this little range here, uh, even though it's moving up and down, is not really conducive to good trade. And you're trading between 91 and 94, and you're watching these numbers go back and forth, but I mean, it's really not a conducive to good trade. So those are times when you have to be patient and then wait for those opportunities. And you have to wait for a breakout. You have to wait for another support level. You have to wait for something, and it might not happen today, obviously. So when the time is finished, it is forgotten and focused on the next opportunity. Very important. Again, it's very important whether it's a winner or a loser. I know it's very difficult to try to refocus when you just had a losing trade. I know it's sometimes obviously a lot easier to refocus when you had a winning trade. You don't have to, uh, you're feeling good, and you're looking at the next opportunity. It's much easier to look at that than if you put two of them in a row where you lose money. Then you're really under pressure, right? But again, it's one of those things that you have to learn how to do. You have to keep it out of your mind. I tried, not to let losing days get to me. I've had opportunities, many opportunities where I have a good day, a bad day, and I can honestly tell you, you take home your bad days. Okay. Um, there's no doubt about it. I mean, no matter how much, you feel like you had your good day. I'll remember all my bad days compared to my couple good days that my good days. I remember all my bad days much clearly than I remember my good days because I take them home with me. So again, so it's if the trade is done and it's you're over with it, just move on to the next thing and look for the next opportunity. Again, it's one of those things that is very important. We talk about it a lot, and it's one of the things that we um, try to focus in on when we're talking to our traders because it's an important aspect of trading that most of us have to get over. All right, so we have a little money management kind of technique to keep ourselves focused on the trades. Again, if you have any questions, anybody, please feel free to write them in. It's not a big deal if you ask me a question, and love to be able to answer them for you. At least I know that we're all on the same page. So please feel free to ask any questions at any time here. There's no I'm going to save the question until the end, but it seems like that's what we're going to be doing. All right, so a little money management technique here to help us again with the psychology part of it and the aspect of not letting a bad day get to you. So let's say you have, just for even number sakes, I'm going to say that we have $10,000 in our account, and we're going to assume that we have well, out of that $10,000, we're going to only risk 10% of that amount on any given day. So you can do the math. If you got a $5,000 account, you got 500 bucks to trade with during that course of a day. If you have a $10,000 account, you got 1,000. Whatever, you can do the math, right? So we're going to risk 10% of that account value. Let's say it's a 10,000, so you're going to risk $1,000 a day. Now, if we're going to go to the idea here that we're going to trade 5 contracts in a day or 5 trades in a day, so that gets us to $200 per each contract that we're going to trade. So now we can go backwards. If we're going to risk $200, how many contracts could we put on if we're going to have a 2-point stop in the S&Ps? So we're going to have a 2-point stop in the S&Ps. It's 2 contracts because each contract is worth $100. So we can trade 2 contracts in the S&Ps given our limitation there of $200 per contract or per trade. That's how much you're going to risk. So now gives you a little bit of leeway. So if that is, makes it a little bit easier for each individual to trade, instead of looking at it like oh my God, I'm going to blow out on one trade. You're not going to blow out on one trade. You're going to keep it. You're going to follow the rules, and it's follow the rules. That's the hard part. But we're going to follow the rules so that way we don't get ourselves caught up in over trading, and you look for the next opportunity in case this was a loser, and you're not going to get blown out of your position. You're not going to get blown out of your account. So keep everything in tow here. Keep everything under control so that it allows you to come back the next day and it allows you to be able to trade. So that's basically how we figure out risk and how we figure out how many contracts you should trade. Simply because it's a little bit easier again for everybody to be able to, focus in on just those little easy concepts and then be able to look for the next opportunity. What is the effect on HFTs on the ES, and how do you trade with or around their influence? Great question. Um, I have a very strong opinion on HFTs and what they do to the market and what they should be doing to the market in regards to how the exchanges should deal with them. They are, you got to remember, I am a trader from the pit. And, you know, if you're trading in a pit and you're taking risk, just as you were if you're trading ES or if you're trading anything, and you get a computerized program to mess you up because they can, because they have the ability to, and because the exchanges want them to. Because why do exchanges want them to? Because they are able to create a high amount of volume at a short amount of time and giving the exchanges more money quickly, right? On commissions and fees. Well, that's why the exchanges like them. But if you're a trader and you have a position that's contrary to the position that any HFT is wanting to try to influence the market in, you're not going to be a happy camper. It's just not going to be a happy camper. And I just don't think it's a fair vehicle out there for individual traders who are trying to trade, try to make money for a living. And obviously, if the position uh, that they're initiating goes your way, then you might be a little bit happier. But I'd rather not have them in there than have to pray that their position that they're going to initiate is going to go my way. Again, we're traders. We're trying to make money every day, and you get the computerized program that comes in there and starts doing stuff that's wacko. It's not fair to most people, 99% of the people that's in there. So that's my position on HFTs and being very nice about it. All right. We have any other questions? Please, again, feel free. This is the time to ask them. This is like the end of our uh, webinar here. Again, we start at 8. Well, the room opens up at 8:15. I get in there just about 5-10 minutes before the market opens up, the S&P, so that we can discuss, levels, talk about what numbers, fundamental numbers are going to be released during the course of the trading day, what numbers were released and how they're affecting the market, what's affecting the market overnight, what the market might be focusing in on. We have a little discussion about all these kind of things, not 5 minutes before, but as the first half hour goes by, because we believe that, first half hour, a lot of setting up a position, sometimes it's not that easy um, to um, to really trade because of the extra volatility. And this is all Central Time. The S&Ps open up at 9:30 Eastern. Well, yeah, 9:30. Well, S&P's Globex is open up all night, all the time. But when the market opens up at 9:30 Eastern, 8:30 here, so we come in there at 8:15, 8:20, talk about the numbers and give you our levels, and then we talk about what's going on. What the market, how the market is being affected overnight, and what the market's looking at, so on and so forth, and it, gives us an opportunity. We look at our, what where the market is in comparison to some support and resistance levels in the past, and we talk about it, and I give you my opinion as to what I think might be happening. Does the Globex market affect the cash market? Well, you definitely you have futures markets are all associated with cash markets, so you can't have one without the other. So yes, the Globex when the Globex is trading, that's going to create or find you the level where the S&Ps are going to open up at the cash market, higher or lower. And so if there's overnight trade in Globex and it opens up, 20 S&P points lower because of something happened, even though the cash market's not open, but when it opens, we're going to adjust 20 points lower in the cash market. So you have a little gap there. You have a little area there that that has to get filled. Yeah, but that's another story for another day. Anyway, but that's how the cash market would open up 20 points lower based on where the Globex S&Ps are. So, then you have trade overnight that you have to look at, but you have to look at it with a grain of salt because it's very light volume. It's not that much volume traded overnight, but there are some support and resistance levels that do come out of those overnight trades that help us once in a while. So, hope that helped. All right, so any other questions? Again, feel free to join us and just click into the into our link there. Again, you got to remember that my booth is from the floor here of the S&Ps on the floor in Chicago. So we do have we're right on the floor. So all the noise that you hear is definitely on the floor. So we are piped into some of the information that we get off the floor, and that helps us sometimes with our traders. I do have some traders who listen to me in the pit. They have the ability to. So we get a little bit of both. I get some information on the floor sometimes as to sometimes where good support and resistance levels are, just because I might know somebody in there, but I can't, I don't share that too often. I can't share it too often, but every now and then. How did I develop the system? That's a good question. It was basically I took my background from the pits which I was trading for uh, a long time, and more than 20 years, and kind of developed it because I realized when I had to make this transition to the screen that I incorporated some of the ideas that I used in the pit, transformed them into the screen, and then created some of my own ideas that I use from the screen that I gained, and put the two together. And the combination of both of them together has come up with this methodology that, I think if you talk to some of our folks in our room who've been with us a while, can attest that, it does work to some extent, and to the fact that it keeps you, making a little bit of money every day. We're trying to do this on an even keel, not to get too excited. So yeah, we can teach new traders actually. We like new traders who don't have too much of an idea about what's going on with anything, because we don't want to have them, have these ideas from another group, and then they have to relearn some ideas or concepts. So if you are a new trader and this is stuff that might be exciting to you, it's a perfect place to learn, because you're not, your mind is not dirtied with some ideas that other people are giving you that, might work, might not work. But, for our discussion, it's very hard sometimes to get rid of old habits. And so some traders who come in who've been with other groups who come and say to me, yeah, wish I got to you before, because I'm learning all this other stuff, but that stuff doesn't make any sense now. Because I put a different spin on it, and I put a spin on it, but basically that I was able to get from being a trader for a while, versus just being on the screen. Did you lose a lot of helpful trading insights and clues by not being able to trade in the pit? Well, what we lost was the ability to feel what the market is doing. Sometimes we get you're watching numbers on a screen and you don't get that feel that you did when you were in the pit. There was some kind of energy that was created, and it was a silent kind of energy, but you felt something happening when there was a move coming, in which you don't really feel it happens when you're on the screen because you're just in an office or in your basement and watching numbers on a screen. So that's why that was one of the reasons why I opened up this room, was because I was up in my office and I was like dying because it was so quiet. I couldn't handle just watching CNBC all day, and after a while they just put you to sleep, and I needed some noise and some action. So we opened up this room down here because it kept me awake. It kept me feeling some energy, which I tried to share with some of our trading room people in our room when something happens, and then you could feel the energy on the floor, and I try to transmit some of that energy. So that's what I lose by not being in the pit, and that's one thing that I wish I could get back, but obviously I can't. And that's something that, again, as a trader, I think you have to. It comes. It just you just don't. You just don't. You either have it or you don't. It's one of those things that's hard to explain. That what feel are you talking about? But it's just the energy that comes through and allows us to trade. All right. Uh, Again, we talked about 1 point is $50, so 2 points is about $100 for each contract that you put on. And we're looking for about 2 points in our 2 points in our trade, so we're looking about $200 for each contract that we're trying to make money on, and we're looking to put it on about 5 times a day. So, if we're looking to um, uh, if you're putting out 5 trades a day, if you make money 3 of them, you scratch one, you lose one, still going to be up some good money at the end of the day. Have I been able to sense anything like the pit from the screen? Yeah, sometimes you get some price action that indicates that there is something going on in the background. And it's basically when we go through levels that we have, and it just goes through levels like they don't even exist, then we know that something's up. And so, yeah, of course that costs you money until you find that out. But then we also know not to keep chasing it, and I usually tell everybody, just let's see what's going on here before we start trading again, because there's obviously something going on. Because if we're going through levels like a hot knife through butter, then something's going on in the background that we need to figure out what it is. So we will stop trading and just figure out and wait till the news comes out, and then we'll be able to see what's going on. So somewhat yes, and especially since we do hear the options pits around us, they get a little bit more volatile as well. All right. Well, I want to just thank Cyber Trading University and Jesse for this opportunity to talk to you. And again, thanks everybody here. Again, just click onto the link and you'll be able to join us. And again, put your proper email address, because that's how we're coming back in. All right. Thanks, everyone.